Hey folks, ladies and gents, Bratt here, the Real Estate Jedi with Big Block Realty. And as you probably know, my partner Jamili Stork and I, we go to a number of events, a lot of training events. And last night we had a special treat. One of our favorite speakers, as far as an expert of California real estate goes, is Bruce Norris. And a lot of you might already know who he is. But we made the drive out to Irvine last night to watch Bruce and give his sort of 2018 his general summary of where he thinks we are and what we can expect over the next few years. And just full disclosure, this is Bruce's materials, these are Bruce's slides. I'm not claiming any responsibility for any of this research or anything. I'm just simply kind of giving a summary of what he went over yesterday. None of this is advice from him, none of this is advice from me regarding this. I'm just kind of showing you what he shared and kind of give you an overall perspective based on some of the numbers that are actually out there. So he is held harmless in all of this, and I hope this is useful for you in the meantime. If you get a chance, go to thenorrisgroup.com or check out Bruce Norris. He hosts annual events such as I Survive Real Estate every single year, fundraisers, lots of great things. He's got tons of great information. And once you get to know a lot of very successful real estate investors in California, you will come to realize that Bruce is one of the most reputable and highly trusted of those, and he's got a great reputation. So I just wanted to give a summary of the short presentation we had last night. And one of the things a lot of people are bringing up is, are we near a peak? Are we coming to the top of the real estate market in California? This is not for anything outside of California. Are we coming to the top of the real estate market, or is this going to continue? Because inventory levels have been incredibly low, and prices have been, what we feel is through the roof, right? I mean, the last peak cycle was over 10 years ago. So it's been a long time, so we kind of tend to forget what things were in this last identical cycle. So anyway, let's just start with this. To get to a peak price, and this is using a lot of Bruce's reasonings. He's compared a lot of things that are always typical and consistent, more or less, through the years on average real estate cycles. So one of the first things we need to get to a peak is momentum in sales. And as you can see, this is October of 2017. We don't exactly have crazy momentum of sales. This is the number of sales, and typically we're speaking about the state as a whole here. As you can see, in 2005, at the peak of the market, sales momentum was incredibly up. Then it came down, then it went up a little bit, and we've been kind of hovering around the same area, since 2010, 2009. So we don't have this momentum in sales. I'm just going to kind of go through this a bit quickly. Let's continue on. You need lenders to say yes to capable and not capable buyers. So of course, what does this mean? Not only are people who should be getting approved for loans getting approved for loans, but people who should not be getting approved for loans are getting approved for loans. The great thing is that's not really the case, as we've been seeing for a long time, and we always point this out to our clients. As you can see, in 2008, the fiscal year 2008, credit score categories. So this is a percentage of what sort of loan originations were being made based on these different credit score groupings. And if you can even believe this, look at this, less than 579 FICO score, 23.4, this is different, October through December, January through March, etc. But let's just look at the top number, 23.4% for less than 579, between 580 and 619, 24%, 620 to 679, this is the largest group, 31%, still below 680. And then, not even prime here, but 680 to 719, much more comfortable territory, only 8.9%, 720 plus credit score, only 8.9%. So anything above 680 was only getting 18% of the entire market of originations. That's crazy. That was 2008. Let's look at where we are now, okay? And this should give you, if this mouse will work. Okay, well, we're still going up to, we only go up to, I think, 2015 here. But nonetheless, the numbers haven't changed an incredible amount up until where we are now from 2015. The numbers are much lower. For these, I don't know what you want to call them, subprime categories, 5.6%, 12.3%. The majority of them now you can see are right here, 40% between 640 and 680, 680 to 719, 25%, and then 16%. Just, between 720 and 850 is almost the same amount, same percentages, the entire 680 to 720. 680 plus previously, up in the previous category. So loans are being made more and more still to people that actually need to qualify for loans. That should be qualified for loans and not the subprime ones. That's a very important indication. Now, you need inventory for sales to be below 3 months. As we all know, inventory has been incredibly low, since I think 13 is when we really started bottoming out the inventory, and it's been more or less up or down since there. But we've still been if I could show you San Diego charts. Our inventory still continues to just go like this and stair step down. So now we are still at incredibly low levels. We are below 3 months, but all of these are not independent. It's not like any independent one of these things that we're saying could indicate a top of the cycle. Not like any independent one is going to signify we're at the top of the cycle. Typically, they're going to coincide and have some sort of relationship to the others for it to make sense. You need trustee sales to be nearing all-time lows. Trustee sales, foreclosure sales. So if somebody's delinquent on the property, if they've missed more than 3 payments, then they're going to get a notice of default, and then they're going to end up going towards a trustee sale. And these are, record. You can see these numbers for the past cycles. So in 1990, they bottomed out, and then of course they spike up during the recession. The same thing in 2005. We're at all-time lows here, and then of course, as we all know, the majority of properties on the market for a number of years were short sales and foreclosures, distressed sales. And 2017, we are at pretty low levels. But at the same time, as we just discussed up here, that's a good thing also, considering that part of the reason we're going to be at lower levels of trustee sales is because loans are being made to people that actually deserve them and actually should be getting approved for loans. You need strong new home construction to drive employment and migration. So here's what's interesting, is part of the reason too we have such insanely low inventory is this is construction, California housing units built going back to 1975. So right here you can see where we are. We're at just under 60,000 units in 2017. 2015, this has just been an insane slump. Even going back through some other cycles, we're still below the norm. What's crazy to mention here too is construction loans, interest rates in 1981, which is about the same level that we're at right now. The interest rates on those are 20.5%, if you can believe that. So people back then, that was the level of construction they were doing back then when it cost 20.5% interest to build something on a construction loan, and that's still where we're at now. So you can see how eager people are to build properties right now. It's incredible. So of course this is holding things back a lot. I would imagine a lot of that has to do with the time frame and the regulations to just getting permits and getting new developments approved. Nonetheless, whatever the reason is, the bottom line is we're not producing more inventory. So if we don't have a ramp up, like you can see here in 2005, look at that, all the way ramping up. So when are we at the peak of the market? This feels like a lot like 2005. Well, it doesn't, because this is our inventory levels for new construction. And then before you knew it, all these builders had all this inventory that they could not liquidate. So we're not even close to that. You can see right here, we still have incredible demand. So that's not really going to be something that's going to play into like that cycle, because we're way below normal inventory levels. Affordability at cycle lows. So affordability, when we take the median home price based on the average interest rate and the median income, that's pretty much how we're going to determine affordability. So what percentage of people at the median interest rate, the median home price, and median income could purchase a home? Well, right now, and of course this is California as a whole, so San Diego is probably a little bit lower than this, other parts are much higher than this. But in general, we're just about 28%, 29% affordability, it looks like. Historically speaking, well, this is an exception. In 2006, we've actually bottomed out at around, I think it was 11%. But historically speaking, typically 17% affordability, once it gets down to that number, is the tipping point. Now, Bruce was pointing out that, based on the way the government's regulating a lot of things with our interest rates and a number of other things, maybe we're not going to get down to that 17% affordability again, just because there's new things that are happening that weren't happening before. That said, we are still at a healthy distance from that as a whole. 28% compared with, 12% is incredible. That means only 12% of the average household could afford to buy a property at the median home price in the market, that's hardly anybody. All right, so he's going to go over a few different counties. I'll start with Riverside, and I'll go to San Diego County. And this is kind of interesting. He has this kind of projected chart. So he's giving a hypothesis here. So if we look at the peak, the last peak, the median home price was $389,406. 2015, it was $322. October 2017, we're looking at $382,500. And if you consider an 80% loan to median home price, and he's looking at the median home at the mortgage payment. All right, so principal and interest payment. So the main thing he's looking at here is affordability. So if at the peak, at the previous peak, the affordability, and this is considering those interest rates back then, if the affordability level at that point in time was $1,842 a month for principal and interest at the median home price. In 2015 it was at $1,232, and then in 2017 it's at $1,460. He's hypothesizing, saying, okay, well, let's just say that we kept interest rates at 3% here, and the interest rates remain at this. What would the potential upside be? Now you can see the median price that he has here goes down. So it's showing how much upside if the interest rates went up. So if, again, we're talking Riverside County here, so not San Diego County. These numbers will be different. At the peak, it was $389. So if we were going to go back up to the same peak affordability of $1,842, which is the number he's looking at here, so he's keeping the interest rate here for 3%, and he's saying what would the price have to be for the payment to be $1,842? Okay, if the rate was 4%, what would the purchase price have to be for the payment to be $1,842? And same thing with 5% and 6%. So you can kind of see then he's going to use this number to calculate what's the potential upside from where we are. And if rates were at 3%, which they're not anymore, 42.8% upside. 4%, 26%. 5%, 12.2% upside, and 6% just barely under a percent. And this will vary by county. He breaks this all down. He's got tons of incredible resources like this to check out. But I'm just going to go over to Riverside there, and let's go to San Diego real quick, because I want you to. All right, he's got this as overvalued, or near overvalued. So I'm sorry. He's going to go to like San Francisco, like you can see on here. Geez, no matter what, even at crazy low interest rates right now. Even if we were at 3%, which we were higher than that, if we're at 3%, he's already saying we're already 14.5% technically overvalued, 24.5% overvalued, 32%, it's just, and this is the interest rates, they just keep going up. Of course, this number is going to keep on going up as well. Now, close to peak counties, he's got San Diego County on here. Now, assume the income peak in 2005 was at $593. Now, he's compensating for this. Peak price was $622 due to aggressive lending. So he's compensating for this, saying, okay, well, there was undue systemic stimulus from lending that was essentially allowing more and more people to buy properties, driving the price up higher than it technically should have been. So that said, he's actually compensating for that, saying, all right, let's just assume the peak was actually $593 versus $622, which it actually was. Same thing here. Assuming 3% interest rates, that would mean that for that same affordability payment of $2,808, we would go up to $832 median home price. At 4% up to $735, at 5% up to $653, and at 6% up to $585. Right now we're sitting around $603. Actually, I think we're a bit higher than this right now. So this number would be, this was October 2017, we're a bit higher than this. I haven't put up January's median home price for San Diego County, but nonetheless, you can see here, of course, as interest rates go up, affordability is going to go down. So if we're at 4% though, or even 5%, you can see there's still actually significant upside to keep that same sort of payment as statistically been the balancing affordability level for the market. Let's just see. So now there's going to be a number of other things, just kind of additional information that he was sharing. California median prices. You can see, this is the past cycles. I'm going to kind of skip through some of this. I'm not going to go into all the nitty-gritty details here. You can see still unemployment is at some of the lowest levels right now. Actually, it's gotten lower than this. I believe this is 2016. I think we're down almost a point, maybe a point and a half lower than that right now. So we're still at some of the most record lowest unemployment rates, which obviously indicates a healthy economy. Interest rates, for all of you who are still complaining about interest rates going up a little bit, you can see historically here, going back to 1970, all right? We're at, well, I'm sorry, if right here we're at 3-4%, 1970s, we all know that interest rates went up to close to 20% in the 80s for a period of time, and then just finally kind of been trending down, but still, relatively speaking, I mean, at 5-6%, we'd still be talking very reasonable rates, relatively speaking, if we were to continue going up. We recently had a hike recently, and I've made a number of videos on interest rates. You can watch those. I'm not going to talk too much about that here, but you can still see, relatively speaking, we're at relatively low rates. Something he was pointed out is regarding trustee sales, trustee deeds. You could see the ratio. All right, well, this is in the 80s. Let's get down to where we are now. Sorry, I'm looking for something else. Maybe I'm not finding it. So go to trustee sales. Okay, I mean, so like you can see, I mean, one thing we have here too is something that's indicating, an indication of a unhealthy market. It's obviously when trustee sales start spiking, and you can see they started going up right here. And if you can believe, at one point in time in 2008, the ratio of trustee sales to all sales was incredibly high there. I mean, that is ridiculous when the majority, almost the majority of the sales happening are distress sales. We're not talking about short sales, we're talking about foreclosures. So trustee sales, that's incredible. I mean, right now we're still at some record lows. Mortgage equity withdrawals, this is something important as well. So as far as where flows, where people are withdrawing money from their equity, you can see, these numbers go way down. The further down it goes, it's showing that we're actually withdrawing less from equity than other times. So if it's going up, more people are taking more equity out of their property than not. Lately, we've actually been paying down more principal than we have been withdrawing equity. So that's a very positive thing. So if you can remember, I don't know about you, but when I first moved to California, I felt like everybody was driving Mercedes, BMWs, Ferraris, Maseratis, Hummers, and everybody was rich, it seemed. Come to find out, a whole lot of these people would just go leverage, $200,000 off their equity that they took out in the last couple of years prior to that, and they went out and were buying boats, cars, trucks, all sorts of crazy things, and everybody looked rich. Right now, we're not doing that. That's very indicative of how conservative people have been lately, which is very good in indicating that we're not going out of control. We have strong lending, underwriting guidelines, and people aren't going crazy on debt. If we're looking at Fannie Mae credit characteristics, so we can see prior to 2008, fixed rates were at a much lower percentage than they are now. So right now, overall book, fixed rate mortgages, we're talking at about 95%. The serious delinquency rate back in 2008, 4%. Right now we're at just under 1%. Serious delinquent, meaning that somebody's missed at least 3 payments and has a high likelihood of foreclosure. So anyway, that's just kind of a summary. You can come to your own conclusions that you like with that. The bottom line is, there are some things that could indicate a top of market, but at the same time, we don't have nearly the same troublesome signs that we did at other times. Foreclosures are at healthy levels because lending is still very strong and it has very high standards for guidelines. People are the credit scores are obviously, like you said, I mean, we could see that the people that are getting financing are actually getting approved for it because they should be. And I'm going to start kind of rambling on here. So I don't want to ramble on too much. Bottom line is this is some good information to keep an eye on. I highly advise, if you want more information on this, let's talk, or go and even follow Bruce Norris, because he's somebody that I always try to keep up on for the California market as a whole. Excellent resource, and he really crunches the numbers more than anybody else, I think, for the entire state. So if you have any questions about this or where the market's going, or you want to get into a property or sell your property and take advantage of these optimal conditions, let's talk. Jed Bratt, the Real Estate Jedi with Big Block Realty. My number is 619-750-2751. Let's talk. I look forward to seeing you in the next video.